I need to see how many are ready to start. If you are there, let me see. I see we are only 36%. Let me see how many are ready so that we can start. Can you hear me? I need to see whether you are there so that we can start. Can you hear me? Yes, I see someone responding. I need to see whether you are there and if you can hear me so that we start. Yeah, I see a number. At least I need some more response. Yes, can you hear me? Very few people responding, so I need more people to confirm so that we can start. I'll give 2 minutes so that you people settle so that we can start. I have only 2 minutes before I start. Okay, if you are there, we can start. I see quite a number. At least we are at 44%. 44%. Let us start. Let me know whether you can see my screen. Can you see my display? Let me know whether you can see my screen so that I can start. Can you see my screen? Is my display visible? Yes, I can see. There are those who are responding. Yes. That's good. That's good. That's good. Good. I want us to continue from where we left yesterday. Yesterday, we started the portfolio theory. We did up to the capital asset pricing model, the capital asset pricing model. And before I wind up the capital asset pricing model, I want us to look at the applications of capital asset pricing model. And this is what I display on the screen. The uses or application of capital asset pricing model, we have 4 applications. The first one is when determining the required rate of return for any security. The other one is in determining the weighted average cost of capital. The other one is investment decision, and the other one is in the efficient pricing of securities. I want us to go to determination of the required rate of return of securities. We say that if we could determine the beta factor for each of the securities, for example, security in the capital structure, we have debt instruments, we got the equity. If we have the beta factor for equity, it is possible to determine the cost of equity, KE, which is risk-free rate plus expected return of the market minus risk-free rate multiplied by the beta factor for equity. If we want to determine the cost of the debt instrument, we say that the cost of debt, KD, is equal to the risk-free rate plus expected return of the market minus risk-free rate multiplied by the beta factor of the debt. That is application number one in determining the cost of equity. Application number two, it is the determination of the weighted average cost of capital. And we say that in the capital structure, there are components of the capital structure. We could have equity, we have the debt, we have the preferred stock. If we have the beta factor for each, it is possible to determine the weighted beta factor. As a result of that, the beta for equity, the weighted beta factor will be equal to beta average is equal to weight of equity plus the beta, that is weight for equity times the beta for equity plus weight of the debt. Let me put this one as weight of the debt. Weight of the debt plus weight of beta of the debt, like that. Let me just make sure that this one is okay. Weight of the debt multiplied by the beta factor of the debt plus weight of the preferred stock multiplied by the beta of the preferred stock. Like this. Let me have it here. That way. So once the average beta factor is determined, we can determine the weighted average cost of capital, which is the risk-free rate. I can give this one the beta average. Yeah, weighted average cost of capital is equal to, if I did give this one as the weighted average, yeah, like that. Weighted average cost of capital is equal to the risk-free rate plus expected return of the market minus risk-free rate multiplied by the beta factor that is weighted. That is determining the weighted average cost of capital. The other one is investment decision or the capital budgeting. Investment decision or capital budgeting. When we are determining the viability of a project, we need to establish or to determine the required rate of return. We say that what is the expected return of a security? When you compare the expected return of a security, you compare it with the return of a security that is determined using the capital asset pricing model. The difference is called the alpha value, and I want to give it here. I want to put it here, ER of J. Let me give it here, ER of security J. We are referring to security J as a so we need to get the expected return of the security J. Let me put it here. This one, we say that this is the expected return of security J determined using the probabilities. The expected return of security J determined using probabilities. Then I will give the return of security J. The return of security J like that. We say that this is a return of security J determined using the capital asset pricing model. So when you determine the return of a given security using capital asset pricing model, you compare it with the expected return of that security that is determined using the probabilities. When you compare the two, the difference is called the alpha value. How do we make the decision? We say that under the decision criteria, if you can look at this, if expected return of a security J is greater than the return of J, that is the alpha value is positive, the security is said to be super efficient, or the security is undervalued. It is therefore worth investing. It is viable. Number two, if the expected return of a security J is less than the return of J, meaning that the alpha value is negative, the security is inefficient or overvalued, hence the security is not viable. And if the expected return of J is equal to the return of J, meaning that the alpha value is 0, then the security is said to be efficient and it is correctly valued. Note this point. These are the ones that you find mostly in an examination, where you are required to tell whether a security is super efficient, meaning it is undervalued, is it inefficient, meaning that it is overvalued, or it is efficient, meaning that it is correctly valued. That is a very critical item. The next application is the efficient pricing of security. We say that the valuation of a security is determined by discounting the cash flows. These cash flows are discounted using the cost of capital. For example, the cost of equity. If we could determine the cost of equity using capital asset pricing model, then we use that cost of equity to discount the cash flow. We will get what we call the intrinsic or the real value of the security. So what are we saying? If this value is greater than the intrinsic, P naught is the intrinsic. Let me put it here. That MPS is the market price per security, market price per security, while P naught is the intrinsic value. This is my P naught. We say that is the intrinsic value, the intrinsic or the real value. So we are comparing the market price per security with the intrinsic value. And we say that if market price per security is greater than the intrinsic value, the security is overvalued in the market. If the market price per security is less than the intrinsic value, the security is undervalued. And if the market price per security is equal to the intrinsic value, the security is correctly valued. When a security is overvalued, sell the security held. If the security is undervalued, you buy more of the undervalued security. Undervalued security. Undervalued security. And if the security is correctly valued, we say that it is at the break-even point. You may hold the ones that you have, and if you have not purchased, you need not to buy more of that security. I want you to ask questions if there is a question before I can take you to the next step. I want someone to ask a question. If you have a question, ask a question. I want to demonstrate this using a question in the past paper. From the past paper, look at a question in November 2024, question 2. November 2024, question number 2. November 2024, question number 2. Let us have a look at this question. I want us to go to it. If you are there, it is a very nice question. Yeah, November 2024, question number 2. November 2024, question number 2. November 2024, question 2. Open that question. Intrinsic value means real value. Intrinsic value means real value or the true value. The intrinsic value, for those who are asking, means the true value or the real value that you determine yourself. It is not given by the forces of demand and supply in the market. It is computed. You compare it yourself. That is what we call the intrinsic value. I want to share that question. For those who do not have it, please make sure that you have it. Make sure that you have it so that we can look at it together. I am sharing it on my end. That is November 2024. Question number 2. 1 minute. Open the question. Let me know once you have it. Let me know from the chat box. Have you seen the question? Have you seen the question? Can we start? I see a good number. I see a good number have seen the question. The turnout is not very nice today. 56% is too small. I don't know what has happened today. Otherwise, let us go through the question. Let's read through the question. I want to read through the question. Question number 2, November 2024. The question reads, we are told that the question is section B, Rwanda Construction Limited. Rwanda Construction Limited intend to apply portfolio theory in order to maximize overall return and improve in investment method. The company seeks to reduce market volatility risk by spreading its investment portfolio over a range of construction projects, including residential structures, commercial complexes, and infrastructure investment. The portfolio manager has identified a number of projects operating in different industries across the country as follows. We are given the companies. There is Abbas Motors, Bobby's Textile, Kobe Computers, Dawood Medical. In each, we are given the outstanding shares. We are given the market price in Rwandan francs. We are given the sensitivity to the market, which is the beta coefficient. We are further given the project expected return. Remember, we talked of expected return of the asset. This is the project expected return is as follows. The companies Abbas Motors, Bobby Textiles, Kobe Computers, Dawood Medicals. The expected returns are given in percentages. The market portfolio return is 17% and the risk-free rate is 10%. That is the first company. That is information about Rwanda Construction Limited. Let us go to Remera Import and Export Limited, that is Riel. Remera Import and Export Limited is exposed to considerable currency fluctuation because it exports agricultural product to Asia and import machinery from Europe. The company is susceptible to changes in foreign currency rates. The Rwandan francs recently volatility in relation to the US dollar and the euro has hurt corporate margins by driving up import cost and lowering export revenue. On 31st January 2024, the company purchased goods in the United States worth USD 120,000 to be paid in 2 months later on 1st April 2024. Rwanda francs futures were available in the money market and could be bought in blocks of Rwandan francs 1 million and each contract cost 10,000. The exchange rate were as follows. We are given the rates. The spot exchange rate on that 1st January 2024, 1 USD for Rwandan francs. We are also given the forward exchange rate on 1st April 2024. We are as well given the futures exchange rates. That is the second company. Company 3, Apex Rwanda. Apex Rwanda, a motor infrastructure development firm, is navigating bond refinancing to manage the debt more effectively. The company aims to take advantage of the lower interest rate to refinance its existing bond, reducing overall interest expense and improving cash flows. This strategic move is intended to free up capital for new projects and enhance financing stability amid this Rwanda economic landscape. Apex Rwanda issue a 10-year bond of 20% Rwandan francs, 100 million nominal value 5 years ago. The bond was issued at 2% discount and issuing cost amounted to Rwandan francs 2 million. Due to the decline in the treasury bills rate in the recent past, interest rates in the money market have been falling, presenting favorable opportunity for refinancing. An expert engaged by the firm to assess the possibility of refinancing debt reported that a new 12% 5-year Rwandan francs 100 million at par value bond can be issued at the cost of 5% and the discount of 3%. The old bond can be redeemed at 10% premium, and in addition, 2 months interest penalty will have to be paid on redemption. All bonds issued expenses, including interest penalty, are amortized on a straight line basis over the life of the bond and are allowed for tax purposes. The company's tax rate is 30% and after tax cost of debt is 7%. Required. A. Based on the information above on Rwanda construction, determine whether the portfolio is efficient, inefficient, or super efficient, and advise on the best course of action to take. Number 2. B. Determine the net gross loss, net gain or loss of using futures contract. 4. Calculate net present value of refinancing decision and whether it is worthwhile to replace the bond or not. That is the question. The last part of the question, I will treat it as a separate topic. Immediately we are done with the portfolio theory. The second company, that is Remera Import and Export Riel, is about the topic we just completed, and the first one is about the topic we are working on. I want us to start with the first one, and I want to read through it again. The first company, Rwanda Construction Limited. Rwanda Construction Limited intend to apply the portfolio theory in order to maximize overall returns and improve its investment methods. The company seeks to reduce market volatility risk by spreading its investment portfolio over a range of construction projects, including residential structures, commercial complexes, and infrastructure investment. The portfolio manager has identified a number of projects operating in different industries across the country as follows. We are given the company A, B, C, and D, outstanding shares, market price in Rwanda and France, sensitivity to the market. The project expected returns is as follows. Company Abbas Motor Limited, expected return is 17.55%. B is 21.60%. C is 15.57%. Dawood Medical is 20.71%. The market portfolio return is 17% and the risk-free rate is 10%. We go to the question. We are required, number A, based on the information above on Rwanda construction, determine whether the portfolio is efficient, inefficient, or super efficient, and advise on the best course of action. I want to give you 2 minutes. 2 minutes. 2 minutes. Read through that question. 2 minutes only. 2 minutes. Read through the question so that we can solve it together. You see how simple life is in finance. Assuming that you have read, I want us to look at this question together so that we understand what is required. I will stop sharing the question and I will share an empty sheet so that we can work on it. The question is, you establish whether the securities are efficient, super efficient, or inefficient. And I want us to do this. Look at that, my screen, if it is visible. We have the companies. I will give these companies. I say that company, the company are A, B, C, and D. These are the companies. The other information that we are told is the outstanding shares, the investment, number of shares. We have the number of shares. These are the shares that this company will buy. We have the market price per share, the market price per share. Then I will call this one as capitalization. Do I need the capitalization? No. Let me give the expected return. We have we have the sensitivity. This is beta factor, the sensitivity. We also have, what else do we have? We have the expected return of each security, expected return of each security, like that. I want us to work on it together. The number of shares, the first one is 120, 160, 200, 250. 120, 160, 200, and 250. This is 120, 200, 250, like that. I have the market price per security. The market price is given as 643, 643. The next one is 438, 438. The next one is 325, 325. And the last one is 471, 471. I hope you can hear me. I hope you clearly can hear me. Having done that, we got the expected, the beta factor. We have the beta factor, 1.04. This is 1.04. The next one is, we have 1.15, 1.15, like that. The next one is 1.15, 0.80, 0.80. And we have the last one is 1.53, 1.53, 1.53. The expected returns, these ones we are given in percentages, and I want to give 17.55. These ones are in percentages. Let me put them in percentage. 17.55, 17.55. Okay, let me give them in 2 decimal places. In decimal places, let me have them like this. That way. So the next one is 21.60, 21.60. The next one is 21.60, 15.57, 15.57. The next one is 15.57, 20.71, 20.71, like that. These are the expected returns for each of the securities. That way, we need to determine, number one, the return of each security. Return for each security. Return for each security is equal to, using capital asset pricing model, is equal to the risk-free rate. The risk-free rate. Our risk-free rate, we are told that the risk-free rate is 10%. 10%. This one plus, you open a bracket, the expected return of the market is 17%. 17% minus 10%. You close the bracket, you multiply by the beta factor of the security. That is the way you go about it. How do we get to this? The first one is equal to 10%. 10%. This one we add open a bracket, 17%, 17%, we minus 10%, we multiply by this beta factor, like that. This one is giving me some percentages, and we can see how much the percentage will be. Let me give it in 2 decimal places, like that. That is the return of each security using the capital asset pricing model. If this is the case, let us get the alpha value, alpha value, and we say that the alpha value is equal to the expected return minus the return of the security. That way, if we brought it down to the end, we can comfortably say that this is the remarks. The remarks. The first one, if you can remember, we say that if expected return is greater than the return of a security, the security is undervalued. If the expected return of the market is greater than the return of the security is undervalued. It is undervalued. We have it again. Expected return 21 is greater than 18. This is again undervalued. The next one is overvalued. Okay. I can go by that. Overvalued. Then we have correctly valued. I can also give the other remarks. The overvalued one, we say that it is inefficient. We have this one is super efficient. This one is super efficient. This one is super efficient. This one is inefficient. This one is inefficient. And this one, we say that it is efficient. That is what the question was about. State whether they are super efficient, like that, super efficient, like that. Is it overvalued or inefficient? Is it correctly valued? That is what was needed. I want someone to ask a question if there is a question. Let me see. Is that clearly understood by everyone? Is that clearly understood by everyone? Is there any question? As I transfer it to our Excel sheet, our Word document. Let me place it here in the Word document. Like that. Or I can even make it look better so that at least it will have the right visibility. That way. I'm transferring it to our Word document. Yeah, sure. Okay, if someone has a question, we have answered that part of the question. Any question? Let me see. Let me see. I did not compute the expected return. Did you read the question? The expected return is given in the question. I didn't compute. Unless you did not read the question, it is there, it is given. Someone is asking, why is the chat disabled? The chat is disabled and you're asking the question on the okay, you can use the question and answer. I don't know how it is disabled, but are you not using the question and answer part? As long as you can write, just ask the question. So that is, if you go back to the question was, let me check the question again. The question was, based on the information above on Rwanda construction, determine whether the portfolio is efficient. That, the one that you have done is for each of the security. Let me now explain the portfolio. That is the security. Let me put this as security, the evaluation of the security. I want us now to evaluate the portfolio. The portfolio. I want to have this information to this point. Allow me to copy this part so that we can evaluate the portfolio. With the beta factor here, I want to do this. I want to create another column here, market value, market valuation, and the market value is equal to the number of shares multiplied by the market price per share. That is the market valuation. That's what we call the market valuation. Let me give this one accounting, like that. That is the market value for each of the items that we have. We are given the market valuation. The next thing that we need to also determine is the weight, the proportion of each company in the portfolio. If you have the market value, let me have the weight. Let me have here the weight. The weight of each company. I will have to say that if I had the sum here equals sum of the portfolio, sum of the market, the total investment. That is the total investment, this one. So I can say that this is the total investment, the total capital. The weight is a proportion which is equal to each item divided by the total. That will give us the weight for each, like that. So if I brought it down here, then I can sum up this. It will give me 1. These are the weights. I can put it as a percentage. Let me change them to percentage. I change them to percentage like that. These are the percentages for each. If these are the percentages, then it means we can determine. I want to give a note. The portfolio beta factor is a weighted average. A weighted average is a weighted average of individual companies. Individual companies beta factor. Individual company beta factor. So this is, if I need to determine the weighted beta factor, I will come and say, let me put it here. I'll come and say this is equal to the weight multiplied by multiply by the beta factor, like that. This one becomes the weighted beta factor for each. So when I sum them, I sum this one, Control U, I will get the portfolio beta factor. This is the portfolio beta factor. It is equal to the sum of this. This is what will give us the portfolio beta factor, 1.19. So if this is the case, can we determine the expected return of the portfolio? Expected, or let me use the word weighted. Expected returns. The weighted expected returns, if again I could come and press it here, I pick the return of the expected returns, these ones. I pick these ones, I press it here. This will give us the expected returns. And if that is the case, I can get the weighted, which is equal to the weight multiplied by the returns, the expected returns, like that. Here I got my expected returns that way. So the expected return of the portfolio, expected portfolio return, expected portfolio return, the expected portfolio return is equal to the sum equals the sum of this. You sum up this like that. This one will give us the expected returns of the portfolio. Let me reduce the number of decimal places to make it look better. Let me give it 3 decimal places like that. So this is the weighted expected return of the portfolio, like that. If this is the case, then we can say that we have the portfolio return. Like that. Let me have it this way. So we have the expected portfolio return. If that is the case, is it possible to establish the return of the portfolio? Return of portfolio. Return of portfolio, it is equal to the risk-free rate was 10%, 10%. This one we add, expected return of the market is 17%. We minus 10%. This one we multiply by the beta factor of the portfolio. This was the beta factor of the portfolio. Let me give it a lesser decimal places to make it look good. Like that. We put it here. We multiply by 1.191. That is the return of the portfolio. And this one will give us how much? This is how we get the expected return of the portfolio. Can someone give me the solution to this part? Someone give me the answer to this. Compute this, put it on your calculator. Give me the answer to that, please. How much have you given me? I need to see. Compute. Someone is giving 18.337. That's what I see. 18.337. Okay, let me press the 18.337 here. If that is what you are getting, that is what I have. Now, look at it this way. Portfolio alpha value. Let me call it portfolio alpha. Alpha value is equal to expected return of the portfolio minus return of the portfolio. This is equal to expected return of the portfolio is 19.143%. We minus the 18. Can someone give me this one, please? How much is it? How much is it? Good, 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 good. We have the alpha value. The alpha value, someone says that it is 0.806 positive. Like that. So what we have the expected return of the portfolio compared with the return of the portfolio that is determined using the capital asset pricing model. And that way we can comfortably say that the portfolio is efficient. The portfolio is efficient. The portfolio is efficient, hence viable. It is no, not efficient. Sorry. It is not efficient. It is super efficient. It is super efficient. Hence, it is viable. And that is what would be expected in an examination scenario, or that is what would be expected if you are to answer this question in an examination scenario. I need someone to ask a question. Sorry, this one should be here. Yeah, that way. Note the portfolio beta factor is a weighted average. That should be note number one. Note number one, like that. Note number two. I'll also put it like that. Note number two, I'll say that the portfolio expected return is a weighted average. It is a weighted average of individual security expected return. Individual security expected return. Expected returns. If we got it like that, then it means we would comfortably say that we have answered the question and we have done it in the very right way. I want to copy this one, then I paste it to our Word document. Oh, let me copy this one. I want to paste it to our Word document. That is a portfolio analysis. Yeah, good. I've placed it on the Word document, so will not you will see it on the Word document. I have placed it there. Good. Unless someone has a question, that is the way to go about it, and that is what was expected of the examiner. Is there any question? Do you need the Excel sheet? And I have transferred the work to the Word document. Okay, someone says that you need them to see where the answer come from. I will share. For those who are asking where I got the market value is the market price per share multiplied by the number of shares held in each company. That's a question I see someone asking. Yeah, so if that is the case, that's correct. I think we can go ahead and try to respond to the next question. Back to the original question, I want to stop sharing the Excel sheet. Let me stop sharing the Excel sheet. I want to share the question again, the original question again. Let me share the question. Let me share this question so that we can read through it together. If you can see the question, I want to read through it. Let me read through the question reads, that was the second company actually. The company is called Remera Import and Export Limited, Riel. Remera Import and Export Limited is exposed to considerable currency fluctuation because it exports agricultural product to Asia and import machinery from Europe. The company is susceptible to changes in foreign currency rates. The Rwandan franc recent volatility in relation to the United States dollar and the euro has hurt corporate margins by driving up import costs and lowering the export revenue. On that 1st January 2024, Riel purchased goods in United States worth 120,000 to be paid in 2 months later on 1st April 2024. Rwandan francs futures were available in the money market and could be bought in blocks of Rwandan francs 1 million, and each contract cost 10,000 Rwandan francs. The exchange rate was as follows. We are given the rates and the one United States dollar per Rwandan francs. Spot exchange rate on that 1st January 2024. Forward on 1st April 2024. And also we are given the futures. We go to the question. The question reads, determine the net gain or loss using the futures contract. The exchange rates are given, forward, and There was some interference, so sorry for that. I want us to, my question is, and I have always asked this question, what kind of a quote is this? Is it a direct quote or indirect quote? Is this a direct quote or an indirect quote? Is it a direct quote or indirect quote? Someone says direct, someone it is direct. Yeah, we discussed a lot about it, and I think I can see now people understand it is direct. It is direct quote. It is direct quote. Let me share my Word document so that at least we can work on it together. Let me share this Word document. If you can see it, there it is. The Word document is there. Good. The question, if I went back to the question, we are required determine the net gain or loss of using futures contracts. The net gain or loss of using the futures contract, because we are given the spot and we are given the forward, then we are given the futures. Let us see. On 31st January 2024, the company purchased goods in the United States worth USD 120,000 to be paid in 2 months later. That is on 1st April. And this transaction was 31st January, so the entire February and the entire March, yeah, those are 2 months. Rwandan francs were available in the money market and could be bought in blocks of 1 million Rwandan francs, and each contract costs Rwandan francs 10,000. So if the transaction size is 120,000 USD, how many contracts will be purchased? We say that transaction size, the transaction size is equal to USD 120. I want us to using futures contract hedge. Futures contract hedge. How much is the amount in Rwandan francs? How much is the amount in Rwandan francs? How much is it? Can someone give me? You are given the exchange rates forward. A futures exchange rate is 775, 777. 775, 777. How much is 120,000 Rwandan francs in 120,000 US dollar using futures contract? How much is it in Rwandan francs? I need to see it on the chat box. Can you compute that? Compute that. How much is the Rwandan francs? Someone says 95,400. Someone says that 93 million. 9,400, 93 million. How much is it? How much is 120,000 US dollar given an exchange rate. And remember, this transaction, we also always remember, is this a transaction of sale or purchase? On that 1st January 2024, Riel purchased goods in the United States. It is a transaction of purchase on credit. It is a transaction of purchase on credit. How much is the amount that will be paid in Rwandan francs, given that this company imported goods payable in 2 months? We are given the futures exchange rate. We are given the futures exchange rate. We are told that this trader needs to pay 120,000 US dollar. How much Rwandan francs does this trader require to have to make this payment? I'm still checking on what you are posting. 93 million, 93 to 40, 93 million, 93 to 40, 93, 95, 400. Oh, we need more intervention. These answers are different and there are many. So can we have more intervention? I need to see you are thinking about it. Can we see the amount? A majority says that it is 93 million. Let us see. Let us see. I want us to work on it. We are given the futures exchange rate. Futures exchange rate. Futures exchange rate is given, if we got it from the question, 775 and 777. Like that. The question is, which exchange rate do we take? Is it 775 or 777? This trader will go to the bank to buy the dollars because this is a Rwandese with the Rwandan francs. This trader will go to the bank, and because this is a direct quote, as we mentioned, the bank will sell at a higher rate. So it will be the Rwandan francs, 777 per USD. The bank will sell high. How much is 120,000 multiplied by 777? How much is the Rwandan francs? The bank will sell the dollar at a higher exchange rate. This is a direct quote. The trader will buy the dollars from the bank so as to make the payment at 777. Let us see how much is it. There's someone who had written it so well, and he said 12,000 multiplied by 777. Yeah, 12,000 times 777. And that is the only person who got 93 to 40. I don't know whether you are getting 93 to 40. 93 to 40,000. Someone is asking a question that has been asked a million times, and I have always referred that to the notes because you have to read. Anyway, as much as I would want to help you, and yesterday I said again, I have explained it. I explained it so well. Check the illustration. The amount is 93,240. 93,240. The number of futures to buy is equal to the 93,240 divided by 1 million. This is equal to 93.24. This is equivalent to 94 futures. 94 futures because you cannot buy a future on credit in fraction. How much is the total amount payable? The total amount payable for this one, amount payable in Rwandan francs, I will say here, amount payable in Rwandan francs is equal to this much, but there is cost of the future, the cost of futures. Each future out of the 94 futures, we are told that each future is costing how much? Each contract costs 10,000 Rwandan francs. This company will have paid 940 Rwandan francs. So the total amount is equal to Rwandan francs. The Rwandan francs, how much is this? Take 93,240 plus 940. This should be 94,180 if I'm not wrong. 94,180. That is the total amount that will be paid. Now let's go to compare. Let's see amount. Let me say that this forward contract. If you go back to the question, we are told that forward on 1st April 2024 is 95. Forward exchange rate. I will have the forward exchange rate here. Forward exchange rate. Forward exchange rate is this much. We say that amount payable is equal to the 799. This is Rwandan francs per USD. This one we multiply by USD 120,000 like that. How much is it in forward? Please give me the amount in forward. Give me the amount in forward, please. Let us get this amount, please. Someone gives 95,880, 95,880. Is it correct? Is 95,880 correct? 95,880, I think that is what a majority one thing I noted is that there are people who log into class, then they go their business, and they are the ones who are asking the question that I have explained so well. So with all the due respect, can you make sure that you follow the class because I'll not repeat what I have said. I have explained all that, why we use the high rate, all that. Actually, it is even in the notes. So please make sure that you attend the class fully. This amount is 95,880, but with the forward contract, note that forward contract plus cost, it will be this much. So we can say that the gain, net gain is equal to the 95,880, 95,880, 95,880. How much is the difference? How much is the gain? How much is the gain of using the futures? So, how much is the gain? Did you determine the gain? 1.7 million. The amount is 1.7, and everyone can see that. We say that it is the Rwandan francs 1.7 million, and I think that is what the question was about. What is the gain? The last part of the question is what we call the refinancing, but for the refinancing we haven't covered. Let me not get into it because I will change the subject of what we are doing. I will do it immediately. We are done with this topic. Actually, this topic we are almost finishing. We are almost finishing this topic. Allow me to finish this topic. I will take you through what we call the bond refinancing after this topic. Let's go to this part. I want us to, we looked at the limitations of the capital assets pricing model. Unless someone has a question before I continue. Unless someone has a question. There is someone who says, okay. Let me see. In the question where they asked to compare using forward hedge. No, we are told to gain or loss, so we can only compare. Someone says that in the past paper answer they have used the raw rate. They have used the raw rate. Okay, let's try to argue it out. When you go to the bank to buy in a direct quote, the bank will sell to you the dollar at a higher exchange rate. So I go by the principles of direct quote. I go by the principle of the direct quote. That is where I stop by the principles of the direct quote. for an importer? Because this question, we are told that on that 1st January, Riel purchased goods. If they purchased goods, it means they imported goods to be paid in 2 months' time. They will go to the bank to buy the dollar. If it was an export, that would be another case. But this is an import. They imported. That is what we are evaluating. And I go by the principle of the direct quote from the information that is provided. And that is why I have done it like that. Let us go to someone is asking, consider the scenario of the question, the bank is not selling. Where will you get the dollar if you will not buy the dollar from the bank? You buy the dollar from the bank. You buy the dollar from the bank. It is the bank selling. So we cannot force the question. We go by the principle. And if you can allow me, I can proceed. I can proceed with arbitrage pricing theory. Arbitrage pricing theory was developed by Stephen Ross and another guy called Ross and Roll. They developed the arbitrage pricing theory in 1976. It is because of the limitations of the capital assets pricing model that they came up with a model that they called the APT. In the limitation of the capital asset pricing model, we talked about the limitation of the capital asset pricing model being a single factor model. It is a single factor model because it only captured one beta factor. While it comes to the other challenge is we talked of a single period, meaning capital asset pricing model was based on the argument that the evaluation of investment is 1 year. The arbitrage pricing model by Ross and Roll is a multi-factor model, and it argues that the return of a given security are not only affected by the weighted beta factor, but they are affected by the multiple factors. For example, today, many organizations are suffering because of inflation, interest rate is high, the market productivity, the global oil prices have gone up, political instability in countries. All those factors do not occur in isolation. They don't wait for each other. They will happen all at the same time. So when using the capital asset pricing model, it becomes to some extent unrealistic because factors that affect the performance of a security are many. So APT proposes that an asset expected return in a linear function of multiple macroeconomic factors, not just the market return. That is what Ross and Roll argued. The core principle of APT is that in a well-functioning market, an arbitrage opportunity that is risk-free profit are quickly eliminated. An arbitrage portfolio is one that requires an initial investment and has no systematic risk, yet it generates a positive return. APT assumes that the return on such portfolio must be zero in equilibrium. As a result of that, the formula for the expected return on a security according to the APT is given by expected return of a security I is equal to the risk-free rate plus beta factor of that security multiplied by the return of that security minus risk-free rate under the beta factor 1 plus the beta factor 2 multiplied by the expected return of that security under beta factor 2 minus risk-free rate all the way, you add them all the way to the beta factor n as a product of the expected return of that security, then we minus the risk-free rate. According to Ross and Roll, they gave the formula as follows. So expected return I is the expected return on the security, RF is the risk-free rate, BI is the sensitivity of the security return to change in factor I, and this is what we call the beta factor. RI is the return, RI is the return of factor I. Then I want to ignore this part. This one will not be relevant. So if this is the case, Ross and Roll helped in determining the return of a security in a multi-factor environment. I want you to ask a question before I proceed with the comparison with the capital asset pricing model. Who is asking a question? Return factor mean what? The expected return. Let me use the word the expected return. It is the expected return. The expected return. I will explain using an illustration so that we understand it better. But before then, let me compare the APT with the CAPM. APT is considered more robust and flexible than capital asset pricing model for several reasons. Number one, number of factors. CAPM assumes that sensitivity return is driven by a single factor. Remember, we used only one beta factor, that is from the market portfolio. In contrast, APT is a multi-factor model that allows multiple systematic risk factors. That means we are considering more factors: inflation, interest rate in the market, political instability, global oil prices, the issue of the government policies, all of them. Number two, the other factor distinguishing between the two, APT makes fewer restrictive assumptions than CAPM. It doesn't assume that asset return are normally distributed or that investors have specific utility function beyond being greedy and risk averse. If you look at the assumption of CAPM, there were so many, making it almost unapplicable. The market portfolio, capital asset pricing model require the market portfolio to be efficient, which is difficult to define and measure in practice, while APT, however, does not rely on the concept of the market portfolio. If you remember yesterday, we said that capital asset pricing model cannot be tested empirically. That increases its limitation. So the empirical test, APT allow for the relative pricing of any subset of asset, meaning you don't need to measure the entire universe of asset to test the theory. This makes it more practical to apply. So we said CAPM cannot be tested empirically. It is not possible to test it. Then we have multi-period framework. APT can be more easily extended to multi-period framework. CAPM assume 1 year horizon. It assume 1 year horizon, but APT is applicable in long-term project, which is more realistic. Investors do not invest for 1 year. Let us look at an illustration. Let's have an illustration for this so that we understand. Someone had asked a question. I want to demonstrate it with an illustration. A financial analyst is evaluating tech innovation in corporate and needs to calculate its required rate of return. The following information is available. Number one, the risk-free rate is 5%. Number two, the required rate of return of the market portfolio, that is expected return of the market, is 11%. Number three, the market APT factor and the corresponding required return for a unit sensitive portfolio are inflation. We are told that a portfolio with unit sensitivity to inflation and zero sensitivity to other factors has a required return of 10%. This is the question. If I go back to your questions, someone asked, return factor, you mean what? The return, if the only factor under consideration is inflation, what will be the return of that security? That is the question. So the thing is, we have the return factor. If inflation is the only factor, the return of this company is 10%. Industrial productivity. A portfolio with unit sensitivity to industrial production and zero sensitivity to other factors has required return of 8%, meaning if all the other factors are ignored, that is why we are calling them zero sensitivity, and the only factor to consider is industrial productivity, the return of this company will be 8%. The other one is risk aversion. A portfolio with unit sensitivity to risk aversion and zero sensitivity to other factors has a required rate of 3%. If risk is the only factor, risk aversion is the only factor, this security will have a return of 3%. So we are told that Tech Innovation Incorporated has the following sensitivity or betas. APT beta for inflation is 0.8. APT beta for industrial productivity is 1.1. APT beta for risk aversion is minus 0.5. The capital asset pricing beta factor is 1.2. The question that I would want you to answer is determine, let me put it this way, determine the return of this company using capital asset pricing model and the APT. From the information that we have, can you give me the return of this security using the APT, or using the capital asset pricing model? Let us try to work on it together. Let's go for the capital asset pricing model. Capital asset pricing model. We say that the return of a security is equal to risk-free rate plus expected return of the market minus risk-free rate multiplied by the beta factor of the security in question. So the return of this security is equal to the risk-free rate, which is, I think it was 5% if I'm correct. We are told that the beta factor is, the cap M beta is 1.2. Do we have the expected return of the market? The required rate of return on the market portfolio is 11%. 11% minus risk-free rate is 5%, multiplied by 1.2 is the beta factor. How much is the return of this security using the cap M. How much is this price? Return of this security using capital asset pricing model. 12.2. How much is it? How much is it? 12.2, 12.2, 12.2. Do we settle at 12.2, 12.2%? I want to explain the APT. APT. We said that the return of a security is equal to risk-free rate plus. I will take that return of that security under risk factor 1. I minus the risk-free rate. I will multiply by the beta factor at the risk factor 1 plus I will take expected return of the security at the risk factor 2 minus the risk-free rate multiplied by the beta factor at the risk factor 2 plus all the way to expected return and the risk factor, expected return of the security at the risk factor n minus the risk-free rate. This one we multiply by the beta factor at the risk factor n. That is what we need to identify in this question. We see how it will go. So let's try to look at the question. We see what is in the question. Let's see what is the question. I'm trying to see whether someone has a question. There's someone who say I don't know RM 11%, not 110. Oh, this one I had given the expected return of the market is, oh yeah, but I believe that is what you used. So let's try to look at this. The risk-free rate, whether APT or whether at a capital asset pricing model, remains the same. We say that the return of the security is equal to the risk-free rate is 5% plus the return under the first factor. What is the first factor? Factor number 1, inflation. Out of portfolio unit is 10%. Beta factor of inflation is 0.8. So we'll take this one. We are here. We say that this is 10% minus 5% multiplied by the beta factor is 0.8. This one we plus expected return, and the second one is industrial productivity, 8%. The beta factor for industrial productivity is 1.1. So we need to give this one, we say that 8%. minus 5% multiplied by 1.1 is for the industrial productivity. Then we add. The next one is the expected return is 3% and the beta factor is 0.5. We give it 3% minus 5%. We multiply by minus 0.5. What is the answer? Let me get the answer for this one, please. How much? How much is it? How much is it? This is giving me how much? 13.3. 13.3, 13.3, 13.3. That is what I see from your end. And if that is it, that is what we call the APT and capital asset pricing model. I've tried to explain it the right way it should be, and I want us to wide up this topic. Unless someone has a question, please, the question that you had asked, I believe they are well answered. If there is a question, please ask before I get to the next item. Is there anyone who has a question? Someone is asking, where are those rates coming from? They are coming from the question. Someone is asking, what are the key objectives of APT? They are to solve the limitations of CAPM. We listed the limitations of CAPM. APT provides the solution. Portfolio must be zero in equilibrium. What does it mean clearly? What do you mean by portfolio is zero? I don't understand your question. What do you mean by the portfolio is zero? Okay, before maybe you respond to that, I want us to move to the last part of this topic, and this is portfolio management. We look at the measurement, the portfolio evaluation, the evaluation of the portfolio. So I want us to look at this last part. When I look at this part, portfolio management process, the portfolio management process is a systematic approach that guides investors in making informed decisions. These are the steps that are involved. Number one, determine the objective and constraints. The first step is to clearly define your investment goal, such as capital appreciation, that is to growth. Is it to get current income in form of dividend and interest? Is it safety of the principal? Is it risk diversification? So at the same time, you must identify your constraint, including your time horizon, liquidity need, tax situation, and personal circumstance. Then number two, choose the asset mix. What do you want to include in your portfolio? This is arguably the most crucial decision. It involves determining the proportion of the different asset classes, such as stock, that is equities, bond. This choice largely depends on your risk tolerance and investment horizon. A more aggressive investor might have a higher allocation to stock, while conservative one might favor the bonds because of the risk factor. Then formulate the portfolio strategy. After deciding on the mix, you must choose a strategy to manage it. The two main approaches are active portfolio strategy. This involves the actively buying and selling assets of portfolio. Outperformed the market. Tactics include market timing, sector ration, and security retention. That is where you keep on buying and selling from time to time as you evaluate the security. Then passive portfolio strategy. This strategy involves holding a broadly diversified portfolio and maintain a predetermined risk level without trying to beat the market. You have so many securities in the portfolio. We call it passive portfolio. The more they are, the more you will be able to diversify the risk. Step number four is select the securities. In the selection of the security, for those pursuing an active strategy, this step involves choosing individual assets to add to the portfolio. When selecting bond, for instance, factors like yield to maturity, credit rating, and liquidity are important. Then execute, implement the portfolio. Once you have selected, you now do the implementation. This step involves the actual buying and selling the chosen assets to construct the portfolio. Then review and revise the portfolio. The market dynamic call for continuous buying and selling. So you don't have a static portfolio. It is something that you can change from time to time. And the last thing is evaluate the performance. That is, finally, you must periodically assess how well your portfolio has performed. The key factor is evaluating the risk return trade-off. This assessment helps in making adjustments and improving future investment decisions. That is, evaluate the performance of a portfolio, and this is the one that I want us to explain. I want to explain the evaluation of the portfolio. Portfolio performance measures. There are quite a number. There are actually many methods, but the most common ones, we have one called the Trinos. the Sharpes, and the Jensens. Those are the ones that I will explain. The Trainer, Sharpes, and Jensen. So we are saying that portfolio performance measures are used to evaluate how well portfolio has performed relative to its risk. Three common measures are the Trainers, Sharpes, and Jensen's alpha. Let us start with what we call the trainer ratio. A trainer ratio, we say that return of a portfolio is compared with the risk-free rate. The difference between return of a portfolio and the risk-free rate is divided by the beta factor of the portfolio. That will give us what we call the trainer ratio. So if I read, the trainer ratio is a reward to risk measure that focuses exclusively on systematic risk. It measures the excess return or risk premium earned per unit of systematic risk, which is represented by the portfolio beta. We say that trainer ratio is equal return of the portfolio minus risk-free rate divided by the beta of the portfolio. RP is the return of the portfolio, RF is the risk-free rate, BP is the portfolio beta. How do we interpret it? It measures the risk premium per unit of market risk. A higher trainer ratio indicates better performance. This measure assumes that the portfolio is well diversified as it only accounts for systematic risk. That is what we call the trainer measure. The next one is Sharpes. The difference between Sharpes and trainer is that trainer uses beta, Sharpes uses standard deviation. If you look at it, they are the same. The only difference is that Sharpes uses the standard deviation, trainer uses the beta. So the Sharpes ratio is a reward to risk measurement that consider the total risk of a portfolio. It calculates the excess return per unit of the total risk, which is represented by the portfolio standard deviation risk. The formula is Sharpes ratio is equal return of the portfolio minus risk-free rate, like the trainer, but you divide by the standard deviation of the portfolio. RP is the portfolio return, RF is the risk-free rate. Then standard deviation of the portfolio return, it is a measure of the risk. Note they are the similar, the difference is the risk. Interpretation is equally the same. It measures the risk premium per unit of total risk. A higher Sharpes ratio indicates better performance. This measure is useful for ranking and comparing portfolio based on the risk adjustment return. The last one is what we call the Jensen's alpha. From your quantitative, you learned about the regression analysis. Jensen deal with regression. So we are talking about the regression model, and I want to explain it. Jensen alpha measures the portfolio excess return relative to the return predicted by the capital asset pricing model. It indicates how much portfolio has beaten the market. How better has your portfolio outperformed the market? That is after accounting for risk. So the alpha is equal to, look at this, the alpha is equal to return of the portfolio minus the risk-free rate, you minus the risk-free rate plus the return of the market minus risk-free rate multiplied by the beta factor of the portfolio. That is what it means. So if this is the case, we will be able to get the Jensen's alpha. RP is actual portfolio return. Then we have the expected return from CAPM. If you look at this one, this is the formula for CAPM. The interpretation means if alpha is a positive figure, meaning it is greater than 0, it means the portfolio has outperformed the market. If alpha is negative, meaning that alpha is less than 0, it means the portfolio has underperformed compared to the market. And if the alpha is equal to 0, meaning the alpha is equal to 0, it means the portfolio performance is exactly as per the capital asset pricing model prediction. I want to explain this with a small illustration. Let us try to argue out this case. Let us try to argue out this. Illustration. The return of the market portfolio is 14.7. And the treasury bills rate, that is risk-free rate, is 8.4%. The standard deviation of the market portfolio return is 2.1. The manager of Convention Investors Limited has compiled the following data for 3 stock portfolio. Stocks XYZ, portfolio, that is stock portfolio XYZ, expected return in percentage. We have for each the beta factor, then we have the standard deviation. The standard deviation. So let me just ignore this. Let me ignore this part. I don't need that. The standard deviation. Using this data, evaluate the performance of each portfolio using the following measures. 1. Trinos, Sharpes, and the Jensens. Let us try to argue out. We are given the expected return of each. We are given the risk-free. We have the beta factor, and we have the standard deviation of each. If you could allow me, I can try to answer them here. Let us start with the Trinos measure. The Trinos measure. This Trino we say that the Trino ratio is equal to the return of the portfolio minus risk-free rate divided by the beta, the portfolio beta. Like that. If that is the case, that is the Trino. I think we can have it in a tabular format instead of consuming a lot of. Let me have it this way. Let me have it this way. We have portfolio, here I have X, Y, Z. I can equally borrow this one. I come here and give Sharpes, like that, like that. The Sharpes is equal to that multiplied by the beta. The beta, so no, this one we are multiplying with the standard deviation. Standard deviation, standard deviation. We have the return of the portfolio, 12.6, 12.6, 12.6, 16.8, 16.8. I hope you can hear me. I hope you can hear me. Let me confirm that you can hear me. Someone is asking, is performance evaluation of portfolio going to be covered in another chapter? What are we doing? What are we doing? Anyway, 16.8, we have 18.9. 18.9 for this one. 18.9. 18.9. We need the risk-free rate. The risk-free rate was how much? The return of the market portfolio is 14, and the treasury bills risk-free rate is 8.4. So we have 8.4. This one will minus 8.4. 8.4. This one like that. The same case will apply on here. Like that. The difference is, are we dividing with beta or the standard deviation? We are given in each case the beta, 0.95, 1.1. So we need to do the division here. This one we divide by the beta factor. The beta factor is 0.95, 0.95. This other one is, I think it is 1.1, while this other one is 1.1, 1.26. 1.26. I assume that I'm correct. I assume that we are correct. So can you give me these values? I want to divide by the standard deviation. Standard deviation is 1.9, 2.3. 1.9, 1.9, 2.3, 2.3, and I think 2.4. 2.4. Yes, so let us have this. Let's have this. Like that. Like that. Like that. Okay, let me give me T X T Y T Z S X S Y S Z. Compute those ones. Compute this. How much is it? I need those values. T X Y Z. Yeah, someone has written all of them. So I can just bring them here, and it would be easier to copy them from here. I have the second one. My assumption is that this computation is correct. This computation is correct. Like that. XYZ. The trainers. Can I have the sharpies? The sharpies. There's another person who says the trainer is 3.7, 7.6, and I know 8.3. Can you confirm the first trainer? Please give me the sharpest. Give me the sharpest. How much is it? How much? XYZ. I see someone has written the three of them. Let me see whether they are the ones that you have. X is 2.21. I assume that X, Y, XYZ. Like that. So the one with the highest is the best. That is what it means. And that makes portfolio Z the best. Let us determine what we will call the Jensen's alpha measure. This was Jensen, Trino, and Sharpest. Portfolio measure. Let us do the Jensens. Let us do the Jensens. Here. Jensen. We got the security X, Y, Z. That's the company. Then we take the alpha value. Let me give the alpha. Let me just copy this formula for the alpha. Jensen's alpha. Jensen's alpha. This one. Let me press it there. This is the alpha. But instead of this, the return of the portfolio, we got the returns of the portfolio. Each portfolio, we are given the expected returns. We have 12.6, 16.8, and 18.9 return of each portfolio. This one we are talking of 12.6 minus risk-free rate was how much? The risk-free rate was 8.4. 8.4 plus the return of the market, the expected return of the market. We are told that the return of the market portfolio is 14.7. Standard deviation of the market portfolio is 2.1. 14.7 is the return of the market. 14.7 minus 8.4. 8.4. This one we multiply by the beta factor. We multiply by the beta factor. The beta factor is 0.95. 0.95. I can borrow this one. This is 16.8. 16.8. This one is 1.1. 1.1. And remember, this one was supposed to be in the same bracket. We first work out this one. What did I do? It was supposed to be that way. So the second one is, this is not, this is, oh, I replaced it. This was 12.6. The beta is 0.95. 0.95. This one was 16.8. This is 1.1. 1.1. Then I have the last one is 18.9. 18.9. I have this one. The beta for this one is 1.26, like that. Okay, can you give me the answer to these ones? I hope I have put them correct. Please check whether I have put them right. Okay, so how much is the first one, second one, and the last one from your computation? The first is 4.21. The first is 4.21. 4.21. That's what someone says. 4.21. The second one is how much is the second one? Please give me. Let me have them, please. Let me have them, please. The second one is how much? Last is X is 1.7. And did someone give X? 1.7. X. Is X 1.7 or 4 point whatever? There's someone who is saying that X is 1.7. How much is it? How much is X? How much is X? Oh, uh, how much? How much is it? X, Y, Z. Give me the alpha so that we move fast. X was 1.75. Okay, there's someone who has written all of them. Let me just use these ones like that. So you say that Y is 1.47. Y is 1.47. Then you have Z is 2.5. Like that. So assuming that that is correct, we have the argument that all our alpha values are positive, meaning that we outperformed the market. And that is the argument that we need to put in place. These ones, we don't need these. Okay. That is it, and I think that's what we needed. Uh, unless someone has a question, I think that is what we needed for the portfolio. Any question? There's something that I need to explain, and which I feel is very, very important. We need to explain. There is that question, we call it bond refinancing. Bond refinancing. Bond refinancing. I want you to take some 5 minutes only to take some water so that I can introduce you to the bond refinancing. I hope we'll be able to finish. Bond or debt refinancing. 5 minutes, 5 minutes break, 5 minutes, 5 minutes, 5 minutes. Good. I think we can continue. Let us continue. I want to explain what we call the bond refinancing or the debt refinancing before we call it off. Bond refinancing. We say that it is replacing the existing debt with another debt which may be having better terms, e.g. the new debt would be having a lower interest rate. The new debt would be having a lower interest rate. So when it comes to the debt refinancing, we carry out a cost-benefit analysis. A cost-benefit analysis. A cost-benefit analysis under capital budgeting. Capital budgeting is carried out to make a refinancing decision. To make a refinancing decision, we carry out what we call the cost-benefit analysis. You need to evaluate a set variable to replace an existing debt for a new one. And I want to give a very simple example. If you are servicing a mortgage, you took a house mortgage, a home ownership mortgage, and your bank gave you the mortgage at, let's say, 15%. Then you get another bank that is telling you, no, we can give you at 12%. You are supposed to look at cost-benefit analysis, to carry out a cost-benefit analysis to ascertain whether it would be a wise decision to refinance. You repay the existing one, you get a new one. It is at a cost-benefit analysis. Now, how do we go about the cost-benefit analysis? So we say that in the following steps. Or let me not use these steps. Let me remove these steps. I say that the following variables are considered. Number one, we need to consider interest rate of both existing and new debt or bonds. Interest rate of both existing and the new bond. Number two, there is what we call the call premium. The call premium. We say that when refinancing or when repaying an existing bond before maturity, the firm may be required to pay an extra amount known as call premium. This is written off. As an expense in the year of refinancing. This is written off at once in the year of refinancing, call premium. Number two, there is what we call discount on issue. In case the existing, or let me put it this way, discount on issue is amortized over the bond life evenly. So when you are recording, if the bond was issued at a discount, that discount is amortized evenly over the life of the bond. So in case there is an amortized, in case there is an amortized discount at the time of refinancing of the old bond, it is written off. As an expense. This is common in bonds where bonds are issued at a discount. The issue of the bonds the issue of the bonds at a discount, issuing at a value below the par value. The other item, we call it the overriding interest charges. Overriding interest charges. Overriding interest charges. If you are replacing an old bond with a new one, you will have to issue the new one first before repaying the existing one. There is a point that you charge interest twice, on old bond and on the new bond. The one charged on the old bond is called overriding interest charge. So we say that at the time at the refinancing point, the new bond is issued first before refinancing the old bond. At this point, interest is paid on the two bonds, on the two bonds, the interest on the old bond is the overriding interest. It should be written off as an expense in the year of refinancing. It is written off in the year of refinancing. And the last item is what we call the flotation cost. The flotation cost. We say that it is amortized. Actually, the treatment of the amortization of the flotation cost is the same as this, is the same as discount. Always remember that. So I'll just put it here, and I'll say that the flotation cost, that is the cost of issue. Flotation cost, we call it bond flotation cost on issue, is amortized over the bond life evenly. In case there is an amortized flotation cost, there is an amortized flotation cost at the time of refinancing of the old bond, it is written off as an expense in that year of refinancing. These are the items that we need to consider when we talk of the refinancing of a bond. So we say that the refinancing, the cost-benefit analysis, benefit analysis for refinancing decision is carried out in the following steps. Number one, determine the initial capital. Number two, determine the annual cash flows. And number three, determine the NPV. We say that cash flows are discounted using the after tax cost of the new debt. After tax cost of the new debt. That is what we do when it comes to refinancing. And I want to demonstrate this one using a question we looked at earlier. That was November 2024, question number 2. November 2024, question number 2. Open that question. November 2024, question number 2. November 2024, question number 2. Let's look at this question. Let us look at this question, please. Just open that question. Open the question so that we can look at it. I can use it to demonstrate. Let's go to the question if you are there. Let me share this question. Let me share the question. Do I have it? Do I have it? I hope you can see it on my screen. We read the last part only. The last part only was on Apex Rwanda. If you can see it, let me read. If you can see it, I want to read. Okay, the question reads, Apex Rwanda, a major infrastructure development firm, is navigating bond refinancing to manage its debt more effectively. The company aims to take advantage of lower interest rates to refinance its existing bond, reducing overall interest expense and improving cash flows. This strategic move is intended to free up capital for new projects and enhance financial stability amidst broader economic landscape. Apex Rwanda issued a 10-year bond of 20%, 100 million nominal value 5 years ago. The bond was issued at 2% discount and the issuing cost amounted to 2 million. Due to the decline in the treasury bills rate in the recent past, interest rates in the money market have been falling, presenting favorable opportunity for refinancing. An expert engaged by the firm to assess the possibility of refinancing debt report that a new 12%, 5 years, 100 million par value bond can be issued at a cost of 5% and a discount of 3%. The own bond can be redeemed at 10% premium and an additional 2-month interest penalty will have to be paid on redemption. All bond issued expenses, including interest penalty, are amortized on a straight line basis over the life of the bond and are allowed for tax purposes. The company's tax rate is at that percent, and after tax cost of debt is 7%. The question is, calculate the NPV of refinancing decision and whether it is worthwhile to replace the bond. I want you to take your time, read through the question again so that we can look at it together. Please read, please read. Read through the question. It is a question that covers everything that I have mentioned. It covers everything that I mentioned. So I just want you to read through it. One minute, please. Let us try to be a little fast. Time is gone. Time is gone. Time is gone. Time is gone. Let's try to work on it together. I hope you can see my screen. Or let me share this Word document. I hope you can see my Word document there. Let us determine the initial capital. The initial capital. When I go back to the question, I want to move step by step. So we are told that Apex Rwanda, a major infrastructure development firm, is navigating bond refinancing to manage its debt more effectively. The company aims to take advantage of lower interest rates to refinance its existing bond, reducing overall interest expense and improving cash flow. This strategic move is intended to free up capital for new projects and enhance financial stability amidst Rwanda economic landscape. Apex Limited issued a 5 years bond of 20% Rwandan francs, 20%, 100 million Rwandan francs 5 years ago. The bond was issued at 2% discount and the issuing cost amount to 2 million. Due to the decline in the treasury bill rate, in the recent past, interest rate in the money market have been falling, representing favorable opportunity of refinancing. Let's get from this part of the an expert engaged by the firm to assess the possibility of refinancing debt report that a new 12% 5-year 100 million at par value bond can be issued at a cost of 5%. So that is the issue cost. That money is needed now. So in determining the initial cost, we have flotation cost of new bond is equal to, we are told that it can be issued now, issued at 5% of 100 million. 5% of 100 million. So I'll give it in million like that. How much is this? 5 million. Or can I give it in thousands? So I'll give it 5 million. That one is a cost that will be incurred right now because we are issuing a new bond. And a discount of 3%. Another cost that will be incurred now is the discount on issue. Discount on issue. The discount on issue of 3% multiplied by 100 million. This one again will give us 3 million. That is another cost that will be incurred now. Discount on issue, let me say, of new bond. Discount on issue of the new bond. That is another cost that will be incurred now. It is being incurred at the time of issue. So it is a cost that will be considered as an initial capital outlay. It is an initial capital outlay. We continue. We are told that the old bond can be redeemed at 10% premium, and in addition, 2 months interest penalty will have to be paid. Another cost, redemption premium. We call it call premium. We call it call premium on old bonds. This one is 10%. We multiply by 100 million. That is another cost that will be incurred today, now, at the point of refinancing. We are also told that 2 months interest penalty will have to be paid on redemption. The old bond is 20% interest. So 2 months interest will have to be paid. We call it overriding interest. Interest is equal to 2 months, 2 over 12 multiplied by 20%. It is on the old bond multiplied by 100 million. Can someone give me that, please? Someone to give me that. Let me have that one. How much has someone shared that? How much is it? Is it 333? Can you confirm that? I see someone written 333. 333. This is what we call the gross initial capital. Outlay. The gross initial capital outlay. Let me have the sum of that. Let me have the sum of that, please. How much is this? $21,333. 21,333. Now, when you incur or when incurring these costs, there is what we call the tax benefit. The tax benefit. There are costs that will be around outlay. There are some costs that will be allowed, so we say less tax shield. Tax shield on. There are expenses that will have to be allowed. We say that the old bond, call premium on old bond. Call premium on old bond. It has the 10 million. That one will be allowed immediately. Flotation cost of old bond, unamortized, we call it an amortized. Flotation cost on old bond. An amortized flotation cost on the old bond. I want to put this one to align it well. Let me create some enough space here. Hello? Niko class, unatakaje? Sawa. So the call premium on the old bond will be allowed. Then we have an amortized flotation cost. An amortized flotation cost on the old bond. Let's go back to the question. We see whether is there any flotation cost that had not been amortized. Let's look at the old bond. Back to the question. Where is this question? We are told that Apex Rwanda issued 10-year bond of 20%, 100 million nominal value 5 years ago. The bond was issued at 2% discount and the issue cost was 2 million. So it has been amortized for 5 years. So the unamortized is the remaining 5 years out of the 10 years multiply by, we multiply by the 2 million. The unamortized amount is the difference, which is this 1 million? Can someone check for me? Unamortized flotation cost. Is it 1 million, please? So the flotation cost that is not amortized, the other thing that you need to consider is that the discount on issue of the old bond that is not an amortized. Again, we talk of an amortized, discount on old bond, an amortized discount on old bond. Back to the question, let's see the discount on old bond. We are told that the bond was issued at 2% discount. So what was the discount? 2%. The period that is remaining is 5 years, 5 years remaining out of the 10 original, multiply by 2%. We multiply this by 100 million. Can someone give me this one, please? Someone help me to get this. An amortized discount. Someone, please. Who has written? Is it confirmed to be 1 million? 1 million, like that. Then the overriding interest charge is an expense. Overriding interest. Overriding interest. The overriding interest, we had computed that, and it was 2%. It was 2 over 12 multiplied by 20% on the old bond, the interest on the old bond. We multiplied by 100 million. This one we had computed as 3 million, 333. So how much is the total allowable expense? Add these three. This is 3, 4, 5. Is it 13, 333? Can you confirm, please? 333. Confirm whether it is 13, 333. Is it 13 or 4? 3, 4, 5. It is 13 or 15. 13, 15. And then we need to determine the tax shield on that. Are we given the tax rate in the question? Let us see. From the question we are given, we are told that the company's tax rate is 30%. So we determine the tax shield. Tax benefit on the allowable cost is equal to 30% multiplied by 15, 333. Of course, it was 333.8 33, something like that. How much is it? 30% on 15,333. We are given the tax rate in the question. 4599.9. 4599.9. If you round it off, is it 4600? 4600, like that. This is what we call the net initial capital outlay. So can you deduct it from the 21? 333? Someone to give me? How much have you given? How much is the difference? Is it 16,733? I see something like 16,733. That is what we call the initial capital outlay. Initial capital outlay. These are the steps that will ever be followed, irrespective of whatever the question. It will always have those components. So you should not be worried that you cannot do it. You can always do it because the components are the same and they will always remain the same components. So we are able to determine the initial capital outlay. The next thing we need to determine is we determine the annual cash flows. Step number 2 is determine the annual cash flows. Determine the annual cash flows. The annual cash flows. Now, I want to show you interest per annum, interest per annum on the old bond, on the old bond is equal to the old bond. We are told it's 20% multiplied by 100 million. How much is this? It should be 20 million. We less interest on interest per annum on new bond, on the new bond. If you can go back to the question, we are told that a new bond will be issued. Where is this? An expert engaged new bond report that a new 12% 5 years bond. So it will be issued at 12%. 12%. So if they are going to go for this new bond, they will be paying interest at 12% from the old one, which is 20%. 12 million is what they will be paying per annum, like that. What is the annual interest saving? Annual interest saving. Annual interest saving. They will be saving each year 8 million. 8 million. Why 8 million? Because they will be paying interest at a lower cost. Let me put them in one page. They will be saving every year, they will be saving 8 million. But now there is tax payable on number 1, interest saving. Because this interest saving will reduce will increase the profit. You will need to pay tax on that. Interest, yeah, interest saving. But for this one, you need to less. There are some expenses that must be deducted. When you go for the new bond, there are some expenses that will either increase or they will decrease. For example, what do we call the amortization cost of the old bond will change. There will be change in amortization costs. And the amortization cost that we are talking of is some of these costs that are amortized annually, they will have their expenses decrease. Let's go back to the question so that I can explain that. Go back to the question. We are told that Apex Rwanda issued 10-year bond of 20%. So there is that interest 5 years ago. The bond was issued at 2% discount. There is discount on issue was 2%. But now we are told that due to the decline, okay, an expert is telling us that 100 million per value can be issued at a cost of 5% and a discount of 3%. I want to explain discount increase in annual discount. Annual discount. We say that discount per annum on new bonds is equal to the new bond. If you went back to the question, we are told that the bond was not that million at par value can be issued at a cost of 5% and a discount of 3%. It will be issued at 3%. 3% multiplied by 100 million discount per annum. This is the discount. This one, we will divide it by 5. Divided by 5 to determine the discount amortization per annum. How much is this? 3% times 100 divided by 5 years. How much is that? 3,000 divided by 5. How much is that, please? $600. Someone says 600. So the amortization will be 600, but we need to compare it with discount per annum on issue on the old bond. Now we do the old bond like that. The old bond had been issued at 2% multiplied by 100 million. But remember, it was issued 5 years ago, expecting to have 10 years. We are redeeming it. So 2% of 100 million divided by 10 years. How much is this? Someone to give me this? $200? Yeah, someone gives 200. 200. With the new bond, the amortization of discount per year is increasing by 400. Increase in discount amortization per annum is equal to the 400. This is an expense that will reduce the interest saving. Then the other thing that we need to look at, we need to look at increase in annual increase in annual flotation cost. We do the same process. Flotation, the flotation cost. We do the same process. Flotation cost on new bond per annum. This one is equal to, we go back to the question. We are told that the new bond issue cost is 5%. Issue cost is 5%. So we say 5% multiplied by 100 million. But this one, we are talking of a period of, this is new bond, 5 years. How much is this? 5% multiplied by 100 divided by 5. Someone to give us this. How much is it? Is it 1,000 or 100? Please confirm whether it is 100 or 1,000. How much is it? A 1,000, 1 million. Which is which? Please, can you just put it correct? One million, like that. I believe it should be that. Then flotation cost on old bond per annum is equal to the old bond. Let's see. The bond was issued at a 2% discount. And the issuing cost amounted to 2 million. So it was 2 million. This one divide by 10 to get per annum. This is 200. Like that. This is increase in annual flotation cost. That is a cost that is increasing. This one you can give it 800. Is there any other cost that come with that? See whether you can see any other costs. So we've talked of the flotation cost, we've talked of the discount on issue. And there was what do we call it? There was what do we call this cost? Overriding cost. There was an overriding. Was there an overriding cost? Let me see from this question. We are told that, let me see. The old bond can be, okay. Let me read. Apex Rwanda issued 10-year bond, 100 million nominal value 5 years ago. The bond was issued at 2% discount, and the issuing cost amounted to that. Due to the decline, an expert engaged by the firm to assess the possibility of refinancing debt reports that a new 12% 5-year 100 per value bond can be issued at a cost of 5% and a discount of 3%. The old bond can be redeemed at 10% premium. We allowed the entire 10% premium. And in addition, 2 months interest penalty, we allowed it. All bond issues expense, including interest penalty, are amortized. All bond issued expense, including interest penalty, are amortized on a straight line basis over the life of the bond and are allowed for tax purposes. The company tax rate is that percent. There is no any other cost. Let's charge this. We say that there is the interest, net annual increase in profit. Take 8,000 minus 400 minus 800. 8,000 minus 400 minus 800. Someone to give me that. How much is this? How much is this, please? 6,800. I see 6,800. 6,800. What is the tax payable? Tax payable is equal to 30% multiplied by 6,800. How much is it? I want to squeeze this one so that we can have a clear visibility. Yeah, this one will give us a clear visibility if you have it. Yeah, what is 30% multiplied by 68? That's tax. How much is this? Someone share. 2040. Someone is saying 2040. And how much is the net annual cash flow? Net annual cash flow minus from 8,800. How much is the difference? Minus from 8,800. Someone to give me that. How much is it? 4760. Is that confirmed, please? 47. Someone says 5960. Another one 4760. Which is which? I see 25960. So do I assume that that is correct? 5960. The difference? Then the last thing we need to do is to determine the NPV. Determine the NPV. The NPV. Remember we said that the discounting rate is after tax cost of the old debt. After tax cost of the old debt. So, after tax cost of the new debt. After tax cost of the new debt. The new debt is given at, let me say, discounting rate. Discounting rate is equal to interest on new debt multiplied by 1 minus tax. The new debt is 12%. We multiply by, open a bracket, 1 minus 0.3, like that. Can someone give me 12 times 1 minus 0.3? Someone says that the after-tax cost of debt is given in the question. Okay, the question that I would ask, which one is it? Which one is it? Let's go by the principle. Let's go by the principle. We don't have the basis. Where did they get that one from? Let us go by what we use. 12% is the cost of the new debt. The interest rate is 1 minus 30%. Let's stick by that because we are not given where they got the 7 from. So can you give me that? I would stick by that. The principle. How much is it? How much is 1 from our computation? 8.4%. I'll go by 8.4% because that is the one that I can justify, and that is what is the principle of refinancing. The other one, we are not told where it came from. So we say that NPV is equal to 5960 million. We multiply by the discounting factor, present value annuity factor, 5 years, 1. Let us put it, I want you to put it in the calculator. 1 minus that is, can someone remind me the formula? 1 plus 1 plus R, 1 minus 1 plus R, 1.084 power negative 5. I want to get it exactly how it should be. Divide by R, 0.084. Get it correct the way it should be. This one, you underline like that. I'll put it in a bracket. Then I'll minus the initial capital. How much was the initial capital? Initial capital outlay was 16,733. Oh, we had loaded 16,733. So let me remove these zeros. 16,733. 16,733, like that. Give me the NPV. Put it in the calculator the way it should be. We need to get it very accurate. NPV is equal to how much? Get me the NPV, get me the NPV, get me the NPV. How much is the NPV? Is someone giving 68.17, another one 23, another one is giving 68.14. Another one, I don't know. Which is which now? Which is which? Can you do it right? Can you do it right, please? Give me the NPV. Give me the answer, what your computation is. I see 68.14. 68.14, a positive NPV. So we say that the refinancing is viable since the NPV is positive. The refinancing decision is viable since the NPV is positive. And that is what would be expected in an examination scenario. I don't know whether someone has a question. That is what we need to work out. The refinancing decision is viable. I think we can leave it at that for today. We've tried to capture everything. That is the best that we could have done for today. At least we have even extended the time. Thank you so much. Have a great evening. Let us meet next week. I believe we are finishing next week. We will finish as expected. Have a great evening. For those who I have your number, you can send me a text so that I forward these notes. Alternatively, they will be forwarded by the management. Have a great evening.